Happy Tuesday, everybody. Yeah. On a Wednesday, happy Wednesday, everybody. My name is Brent Moores, and time for managing an options portfolio. I was out of the office yesterday, so you'll forgive me on that one, but it's good to be here. And today I want to talk a bit to you a little bit about portfolio risk and kind of, is it right for your portfolio? Or are you taking too much risk in your portfolio? And we'll look at individual options positions here and managing those positions. So we're going to do that coming up. By the way, you can always follow me if you're interested on X at BrentMooreCS for some additional content along the way. And remember, we'll be talking about options today. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a recommendation or endorsement of any particular security, chart pattern, or investment strategy. Paper money application that we're going to be dealing with today is for educational purposes only. And I may not factor in commissions and fees in the example trades that we look at, but just realize that that's a real thing. So just please pay attention to that. All investing involves risk, including loss of principal. And past performance of any security or strategy does not guarantee future results or success. And just want to welcome everybody. I see some familiar names in the chat. Good to see you, everybody. If you're watching on recording, that's great too. We're glad to have you as well. Also, let me just point out in the chat, I've got Ben Watson helping me out today. I appreciate Ben. I've been working with Ben for over 2 decades now, and I've learned a lot from Ben over the years. He's familiar with all the concepts I'll be going through today. So as you have questions, feel free to put those in the chat between Ben and myself. We'll do our best to help you out. Also, make sure you check out Trading Index Options. That actually precedes this class weekly, but it's recorded as well. Ben teaches that class. It's a great class. I think it meshes well with what we cover in this class. Let's bring up the markets here. This is intraday. We've had quite a bit of move. In fact, early in the chat, those of you in the chat saw Paul talking about the intraday volatility. He was looking at small caps, but this is the S&P 500. You can see the big dip we've had, quite a quick move in the market. There's all types of traders. You know, this is an intraday chart. If you're a really short-term trader, sometimes we'll call those scalpers, you know, intraday, then this may be more impactful to you. But if you're let's say, more of a trend trader or something like that, then maybe you don't look as much as those intraday charts. Either way, that's fine. Either way, I want you to be aware of the risk in the market and the risk you're taking on any trades. And before we go too far into this, there's 2 terms that are kind of terms that we talk about a lot that I think are important for you to know. And then I'm going to tie these together. So the terms are delta and beta. Delta and beta, Greek terms. And how do they impact the market? Well, let me just talk about this. Let me go here to a stock trade. We got 100 shares of CNP in this paper money portfolio. And so if CNP were to drop $1 per share and I have 100 shares, how much would I lose? Well, I'd lose $100. 100 shares, $1 per share. And that's reflected in the delta. If the stock were to go up $2 per share and I have 100 shares, I'd make $200. So in other words, my delta is 100. In other words, if the stock goes up 2, I'd make $200. I take the number of shares for a stock, multiply it by the dollar change, and that gives me my delta on stocks. Easy enough. And if I had 50 shares, then my delta would be 50. Delta for stocks equals the number of shares. For options, it's not that straightforward. If you do long calls or short puts or vertical spreads, the delta is going to be some different number. On BK here, I've got a mix. I've got a mix of stock and options. We'll look at this a little bit more later. And they have their own deltas. And if Bank of New York Mellon moves up $1, per share, then my portfolio is likely to see about a $63, $64 gain. If Bank of New York Mellon went down $2 per share, what would that affect my portfolio? Well, about $126 to the losing end of things here, because that's my delta. So we can always look at delta there, but it becomes a little bit more, so that's the first thing I want you to learn is delta, is understand delta. And I know a lot of you already know delta, but stick with me for a sec, because I think this is an important concept. Let's talk about another concept. The other concept is beta. Beta is a measure, a lot of you have heard of this. Beta is a measure of how much a stock is going to move in relationship to the S&P 500. Let me pull up Chipotle. Okay, here's Chipotle. And if you just if you're on the trade page and look right here, you can click and you can look at beta. Now, there's beta, there's fast beta. I have fast beta here. This is looking at the last year. Beta is looking at the past 5 years. But the point is, this is telling me how much the stock is statistically has moved in relationship to the S&P 500. The S&P 500 is our benchmark. S&P 500 is our benchmark. And so if the beta is 1, statistically, we're expecting a move right in line with the S&P 500. Okay. If the beta were 1.5, we'd expect roughly 50% larger moves in the same direction as the S&P 500. If the S&P 500 went up 1%, we'd expect the stock to go up about 1.5%. In this case, our beta is a little bit under 1, so slightly lower moves historically. Doesn't mean anything about the future, but we don't know what the future is going to be. But what that means is it's likely to move just a smidge less than the S&P 500. Okay, now, so that is an important measure for the markets. We can combine these two together and we can say, how much are each of these positions? I've got a whole variety of positions here, and rather than have them all grouped in different categories, what I'm going to do is I'm going to click here and I'm going to get rid of my groups just so I can see all my positions together. I have a whole cornucopia of options positions and different types of trades in here. Now, if Apple is moving up $1, we can kind of see what the delta is, but that's very different than if AbbVie moves up $1. So we can kind of relate all these by doing what we call beta weighting. Remember, beta is adjusting or comparing the movement of a particular stock to the S&P 500. If I click on beta weighting and beta weight it to the S&P 500, which is SPX here, I can now see what my potential delta move is for any of these stocks for the S&P 500. I would encourage you, if you're following along on your Thinkorswim desktop software, to do the same thing, to beta weight, just to kind of follow along in the lesson. If not, just pay attention and you can do this at a later time. I'm going to look at my delta column here. Here's my delta column. My delta column is giving me a total delta for my portfolio. It's about 15 right now. Now, sometimes you may see, just a heads up, sometimes you'll see like it says NA or something down there, not available. And if you look through your line items, usually what the case is, there's one culprit, and I don't have one here, but it isn't giving you a value for some period, for some reason. And if we have and so it messes up the whole total here. But here I do have the total. My total is about 15, 16, something like that. Okay. So that's my beta weighted delta there. And so I can see what the risk is in my portfolio. Now, how do we interpret that? What that is saying is, if the SPX, because that's what we beta weighted to, if the SPX were to move a point, we would expect roughly a $15 move in my overall portfolio. Now, some of you are saying $15 isn't much, Brent. You're right, $15 isn't much, but a 1-point move in the SPX is very, very little. Let's look at the SPX real quick. Let me just pull that up. SPX today, well, we're basically break even today. It's only moved about 4 or 5 points. But consider a 1% move on the SPX is about a 62-point move. 1% isn't outrageously big. So in other words, if I were to take a 1% move, about 62 points in the SPX, and multiply that by my beta weighted delta, 62 times 15 is giving me about a 930, and I'm just rounding these numbers, by the way, about a $930 impact on my portfolio per 1% move on the SPX. Now, the delta will change over time. The delta will change as the market moves. So really, this is just telling us what a $1 move is, but we can kind of extrapolate a little bit just to give you an idea of the risk in your account. It can give you an idea of the risk in your account. So, for example, let's say we had a 5% move in the SPX. Well, how much am I risking? Well, 5%. I'd go 5 times that. This is a 1% move, $62. We already looked at that. 5 times 62 is, what's that? That's roughly $3,000. Excuse me. 5 times 62 times my delta here. So if I were to do 5 times 62 times my delta, which is 15, gives me about a $4,600 downside. Are you comfortable with that? You got to do the calculation for your own portfolio. Now, nobody wants a $4,600 drawdown in the portfolio, but if you're going to be in the markets, you're going to endure risk. And so you need to decide what level of risk you're comfortable in the markets. So my first thought to you is this. Look at your delta in your portfolio and realize, beta weight it, okay? Beta weight it. Now, you don't have to beta weight to the S&P 500, but that's kind of the typical one that people will do. For a large cap portfolio, if you had a small cap portfolio, maybe you do the Russell 2000, RUT, okay? If you had a tech heavy, NASDAQ heavy type portfolio, maybe you beta weight it to the NDX instead. But for our purposes, I'm going to stick with the S&P 500. So I want you to consider that risk in your portfolio and how much that risk is. Now notice, in addition, there's a theta column and a vega column here. And I can see what my total theta is in my portfolio, minus 190. This is a pretty heavily time decay intensive portfolio. I'm losing, everything else being equal right now, about 190, the number's jumping around, $190 per day, everything else being equal, just because of time decay in that portfolio. And so where do we want it to be? Well, your delta is going to be dependent. Where should your delta be? Your delta is going to depend on your investment objectives, okay? Is this intended to be a long-term bullish portfolio or a bearish portfolio? Okay? That's kind of a big consideration, right? Most traders, and this isn't everybody, and this is not recommendation for you, most traders have observed that over time, over long periods of time, the market has tended to go up. I don't know what it's going to do in the future, but so therefore they've kept a kind of a positive delta on their portfolio. But if you were very bearish, you may want to shift that down, okay? So your market outlook is going to be, your investment objective is going to be one thing. Okay. Your market outlook, which is kind of similar, I mean, it's a little different, is maybe where do you think, you may be long-term bullish on this thing, but maybe you're kind of bearish in the near term over the next couple months or something. So your market outlook is probably going to affect you where you want your delta on that, right? And then there's another thing. What's your overall risk tolerance on your portfolio? The higher your risk tolerance, the more your delta, the higher your delta can be. Okay, or is maybe appropriate for it to be. Everybody has their own risk tolerance, so you got to realize that. So that's kind of those are three kind of considerations on that delta. And keep in mind this also. This here I have modeled is basically an options portfolio. I have a couple of just pure stock positions in it. I have a few cover calls or things like similar where they're largely stock positions. But this is an options trading class, so we focus on options. There's a danger though. The danger is you get the impression that a typical portfolio is going to be 100% options or 80% options. Most traders, I'm not speaking to any individual out there, but most traders are not comfortable with an options portfolio that is your whole portfolio. A lot of traders will maybe have a kind of a longer term, for example, stock portfolio with a smaller portion of an actively traded options portfolio. Okay, so the long-term, in this scenario, the long-term stock portfolio would probably have a pretty high delta, positive delta. That's typically how it is with stocks. But the options portfolio, maybe you strive for something that's closer to, maybe it's bearish, or maybe it's more neutral. Sometimes we'll talk about a delta neutral portfolio, which means a portfolio where basically delta is going to be very low, where maybe we're trying to take more advantage of time decay than anything on that. So those are some considerations on your overall delta, but it starts with the math. Beta weight your delta, look at it and consider it in terms of, if you're going to use the SPX, consider in terms of percentages, probably would be my suggestion on that. What's a 1%? What's a 5%? What's a 10% drawdown? 10% drawdowns happen quite frequently in the market. Not typically several times a year, although that's possible, but maybe once a year you may see a 10% drawdown in the market, entirely possible. So, and it can happen more than that. Okay. Now, what about theta? So we just talked about delta. What about theta? Theta, theta is kind of good in itself if you just look at theta. Okay. Theta is, ideally, we have a portfolio that has the delta that we want and the vega that we want, and the theta is just positive, high as possible in terms of time decay. Realistically, that's not how it works. Very often, if you're doing a trade that you want, let's say you do a long call, and that's going to help you in terms of your goals for delta. Well, your theta is going to be negative in that case, right? So you sometimes you don't have a choice, but everything being equal, a lot of times what a lot of options traders like to do is they like to keep that theta positive. Now, we don't have a positive theta, okay? Right now, we're going to do a measure that's going to change that here in just a little bit because my theta is pretty big to the downside right now. But theta, generally positive. Delta, it's going to be more with your outlook. Theta, generally positive is probably better. Vega's how much your portfolio moves is going to change with time decay, not time decay, implied volatility changes. So if you're more Vega, if you think implied volatilities are more likely to go up, okay, you may be looking, say, at the VIX here, and you're looking at this VIX down here, it's right about 17, 18 right now, and you think, it's more likely to go up a little bit here, then it probably behoove you to have more of a a bullish or a positive bias, a positive vega. If you think, the market's going to settle down, trade things are going to, tariff things are going to kind of work themselves out, and the economy is going to do really well, then that's more likely to move implied volatilities down, and that may behoove you to have more of a negative vega there on that. So consider that for your overall portfolio here on this. Now, I can look at this and we can see my totals and where we're at and how we want to go on that. Now, let's go and let's talk about how management can certainly affect these things, right? So the first thing I would say in terms of managing your delta, your theta, your vega is consider your current portfolio and consider taking existing positions off as a potential. Sometimes we're always looking to add more positions on there. But remember, taking positions off that portfolio may affect it. So for that, let me start off with this. Let's go to JP Morgan. JP Morgan is a trade that is not looking so hot right now. My PL open on this trade, down $600. This was an earnings straddle. Okay, JP Morgan just had earnings. Okay. And so what do we want on a straddle? What's our goal on our straddle? A goal on a straddle, remember we've got a long call and a long put, is movement. We want a big move, doesn't matter whether it's up or down, but we want that stock to move a long ways. Well, here was our earnings on JP Morgan. Okay, it came out yesterday morning. And the day before it closed here. The next morning, next day, yesterday, we closed down just a little bit. Today, we're down a little bit more. But in terms of earnings, that's not what we're looking for, right? In terms of earnings, what you're looking for is a big move like that, okay? Not this. And that is why we are losing on this straddle right now. But consider this. When you do a earnings straddle, there may be different reasons you do a straddle. But if you do an earnings straddle, the typical management of the earnings straddle is you get out as soon as the earnings is done. Now, we could have gone out yesterday. And if we got out yesterday, it may have saved us a little bit of money here. But I like to manage during this webcast here too. So we're going to look to exit. But how's this going to affect my portfolio? Well, look at JP Morgan. This has a negative almost 100, negative 98 on my theta. This is a time decay hog on my portfolio. This is killing my portfolio in terms of the time element on this. Number one, we have two long options, both theta positive, okay? Both theta positive. And number two, we're near expiration. And for those of you, when you're looking at like time decay, theta, the rate of theta, it typically gets higher as you get close to expiration. So we got the double whammy. We've got two different long options, and we've got right near expiration. And we're pretty close to the stock price too, which is going to have the highest theta as well, right? Because at the money contracts tend to have higher thetas. So we actually kind of have the triple whammy of time decay on this. I'm going to get out of this trade regardless of what we're doing here, but regardless of the theta. But this is going to, notice what's going to happen to our overall theta here, which is now showing at minus 160 on this when we get out of this trade. I'm just going to click out of these. I'm going to create a closing order. We're going to sell that straddle. Let me just go off here, confirm and send, and I'm going to send that order. Okay, we are now out of that trade. And now let's look at our overall theta. Here's the theta column. just see it. Is that going to keep that? Yeah, that'll keep that so we can see it. By the way, just a little hint for everybody. If you are on Thinkorswim, if you're using this, the Thinkorswim desktop platform, and you're scrolling and you're like, I want to see the column headers, but they're going off when I'm scrolling down, this little anchor right there kind of pins the column headers there. So now when I scroll, that theta stays put there. Okay? So now look at our overall theta. That's a lot better. Okay? That's like four times better, 5 times better than what it was in terms of that. So, wait. Oh yeah, it's bouncing around pretty significantly here. But anyway, theta has improved a lot. So the first thing to do when you are considering adjusting your overall Greeks, consider the existing positions that you have, and we'll look to possibly take those off. Now, I did that for 2 purposes. One, it was time to manage, and that's how you manage a straddle. Now, we actually had in a feedback the other day, we had a question regarding how do you manage straddles? This one was kind of I won't say unique, but it's a specialized case of an earnings straddle. If you're managing earnings straddles, typically after earnings, we're going to get out. We're not going to hold on to these for many, many days or weeks if they're doing that. Okay, but if there's not a concrete earnings event, then typically the reason you put a straddle on in the first place is that you expect more volatility of a stock. Maybe it's not earnings, but maybe it's a news event, or maybe there's an economic environment, or some reason you expect more. When that period of higher expectation movement is past, that's when you're going to get out of that straddle. Okay. Now, let's look at another one. Okay, let's look at Microsoft. This is a different trade. This is actually one that's working out pretty well. I've only got 2 days till expiration. This is a long call vertical, and it's a 465, 480 call vertical. Ideally, we want the stock to go above our upper strike. Now remember, the short call, theoretically, we could get assigned early on this. So we don't want to stick with this too long here, number one. Number two, we're doing really well. And we've only got 2 days to go. So we're just going to take our profits on this and get out. Now, I'm going to manage this with 2 days to go, really a week to go, regardless of whether we're making money or not. In this case, we're making money, so that's a bonus. But to get out of this, I'm going to cancel out of I have some stops on here. I'm going to cancel out of those. And then what I'm going to do is I'm going to click on these and right click and it should right click. For some reason, it's not letting me right click here. I do not know why that is. That's really odd right now. Let me just kind of flip to another page, see if that kind of jogs it back. Huh. It will not let me. There we go. Now it right clicked. Okay, I'm going to create a closing order. I'm going to sell out of this vertical. Now, let me talk about this. When you're closing out positions, particularly if you have several legs, not just 2, but even with 2, sometimes if you can't get a fill closing out those multi-leg positions, say we couldn't get filled on this order, then it may behoove you to close out 1 leg at a time. Okay, so in this case, I've got this vertical here. Now that's my mid price, probably optimistic to get filled there. But I'm going to go down a little bit here, okay? And we'll see if we fell. Okay, I'm going to confirm and send, and I'm going to send this order. Okay, there we go. So it is, that filled. But if it didn't fill, we may go and just look to close out one side at a time. Yeah, Paul said you leg out. Now, Paul also said, because I talked about managing straddles versus strangles, I would say your management of straddles and strangles are going to be roughly, basically the same thing in terms of those, okay, in terms of how we're managing those. They're very similar trades, aren't they? Just different strike prices, okay? Let's go, so that's Microsoft, okay, that's Microsoft. Let's look at some other trades and talk about management. Let me just we're doing good on time here, okay? So let me get rid of that. And I'm going to go to Adobe. And look, we've got a put on Adobe. This put has been doing great, okay? Doing really good on Adobe. It's a trend trade, okay? It's a trend trade. 65 days to expiration. So let's look at what we got for an exit here. So I've got a stop on this to get out at 12.10. Okay, I don't have a target price on that, and that's typical when we're doing trades in this class that aren't swing trades, where we'll normally put it on a target price. With a trend trade, our assumption is we're just going to stick with this as long as it keeps going bearish on this. Okay, so first thing, if it's no longer going bearish, we're not going to stick with the trade. So let's do Adobe. Let's just take a look. Are we still bearish on Adobe? This is a long put. I'd say, yeah, from this look right here, and you may disagree, that's fine. This is from the just going by a trend, which is what we've been going off of, and following the rules of this type trade that we normally follow. We're going to continue our bearish posture on that. Okay, but I also don't want to give up too much in case it does reverse on us. When we bought this originally, we bought this put for $24. Right now, it's moved up to $33. When we bought this put originally, we put a stop in at 50%. Our stop was at $12 on that. We just looked at that. So is it time to move up our stop? Maybe a little bit. Look, I'm going to say the stock is around, or the option right now is around $34. Half of 34 is 17. Therefore, what I'm going to do is I'm going to go to the stop, and I'm going to say, I'm going to move this stop up from $12 to $17. So I'm going to right-click on this. I'm going to cancel and replace this order. There's my stop right now, and I'm going to leave it as a stop, good till canceled. I'm going to make this $17. And just remember, when we have a stop, we're not guaranteed as to what price it is going to stop out at. Okay, when this stops out, if the option goes down, it could stop out at $2 for all I know. But likely, if it's a more reasonable drop and not just a huge gap down or something, will likely be closer to where the stop price is, but there's just no guarantees on that. So I'm moving that stop up. I'm canceling, replacing the order. I'm moving that stop up in case this option goes against me, and we're going to just move that stop up. Okay? Hoping that makes sense, everybody. Kind of protect some profits that we have here on this. Let me shrink this down here. Okay, so we just did Adobe. Let's look at some others here, okay? Because we've got time. Let's look at a different type of trade. Let's go to BlackRock, which we briefly looked at the beginning. Again, only 2 days to go to expiration. This is a longer-term stock trade, but BK, Bank of New York Mellon, had earnings. And our protection, we put on some protection before earnings, okay? We don't always do that, but sometimes we do. And in this case, we were a little bit worried about this. We put on some protection before earnings, and, well, let's see, what did Bank of New York Mellon do on earnings? Here's BK. Earnings when was it? It was yesterday morning. it climbed up throughout the day, but then today we've reversed ourselves on that. So again, kind of like JP Morgan, not a massive mover. We were worried a little bit about a massive move to the downside on that. Okay. And there we go. Okay. So Greg, you have a great question. I'll address that question in just a minute. Okay. Very good question. So let's do, so I'm going to take this, by the way, I don't know if I mentioned this. This is a collar. Okay. This is a collar. A collar is when you have the stock and you buy a put and you sell a call. So it's kind of like a covered call with a protective put on it. Okay, that's how a collar does. It adds quite a bit of protection in case it moves against you, but we're past earnings, we're past that event, so it's time to get out of this. So I'm going to just highlight both of those. By the way, if you want to highlight both of those, you can just click on one, then hold down your shift key on your keyboard, click the other one, and then you got both of them highlighted. I can create a closing order, and I'm going to get out of both of these. Okay. Again, you can lay out one at a time if you need to here on this. Okay. So here's what I'm going to do. I'm going to get out of those, confirm and send. We lost a little money on that. Now look, it didn't fill. It did not fill. So let's just say, now we could just play around with this and let this go a little bit, but here's what I'm going to do. I'm going to cancel this order. Okay. So I've canceled that order, and let's do what we were just talking about. What I'm going to do here is I'm just going to get rid of this, each one at a time. I'm going to get rid of this call. Okay. And I'm going to confirm and send and send. We're out of the call now. And now I'm going to go to the put. I'm going to right click on that put. For some reason that right click again is not working for me. It's so weird. Okay. Well, I don't know why that's not working, but here's an alternate way of doing it. I can go here and I can go to look at my position, excuse me. I can look at do I need more trades in there? I can look at my position right here, and I can see why that wasn't filling, because my bid price is essentially 0 on this long put right here. So it's doing this right now. I'm just going to move that up, confirm and send. If that price changes, then we'll get out of that trade. If not, we'll just stick with it through expiration. It's out of the money. It's not going to be, it probably shouldn't be an issue on that. Okay. So now let me address a couple questions here. First one, is it important which leg you exit first? Okay. Is there any danger? That is a wonderful question. Absolutely a great question. The answer is sometimes it does matter. In the case of the collar that I had, it really didn't matter, because if I got rid of the long leg first and left the short leg, I wasn't left with like a naked option. Okay. If I just have a vertical spread and I get out of the long, say it's a long call vertical, and I get out of the long call first, I'm left with a naked call on the one side. Okay. So we don't want that. We don't want that. In the case we were doing with BK, Bank of New York Mellon, it probably didn't really matter because I have 100 shares of stock. But just as a kind of, so you don't confuse yourself on that, as just a best practice, as Ben mentioned in the chat, best practice, probably just get out of that short leg first. Okay. When you're doing that. Great question. Now, Paul said Greg said earlier, on Adobe, which we were looking at earlier, I just adjusted that stop. Could I have also instead, let me get rid of my beta waiting here on this. Could I also have rolled this trade and captured some gains on this? Absolutely. Yes, I could have. My delta on this is about 63. Probably more commonly, in the rules that we've kind of traditionally used in this webcast, is when we get closer to the 70 to 80 delta, that's when we're going to be looking to roll that. This one's a little bit shy of that, but absolutely that's a possibility. So what Greg was saying was, look, instead of just moving the stop up, we could say, hey, instead of doing this 385 put, we could maybe roll that up to a little bit of a, roll it down to a little bit of a lower delta and okay, hey guys, thanks. Sorry, little tech issue, whatever reason, but I'm back. So any case, we could have rolled that. We could have in the case of Adobe, and we could have rolled that and brought in a little credit there. So it's just your call on that, whether you want to do that. So let's just look at a couple others real quick here before we finish our session off today. There was a question on doing a trail stop. You can do trailing stops. Just be careful. Okay, my caution to everybody on trail stops, especially on options, is options are very volatile. And traders tend to underestimate how quickly trail stops will get triggered on intraday volatility on those. So even though the trade's going pretty much how you want, generally go in the direction. So that's why I traditionally am less likely in this class to do trailing stops. All right, everybody. Hey, sorry about that. Looks like, hey, we're having a little technical gremlins here. I'm going to finish this off, but let me just finish this off with this. General Electric, we're under 10 days to go to expiration. I'm going to look to close that out as we do on most vertical spreads when we get to be about a week till expiration to go. I'm going to call it there, everybody. We're just about at time. Thank you for joining me. Thanks, Ben, in the chat. And we'll see you all same time next week. Bye-bye, everybody.